I had concluded my 2021 update by saying that hopefully 2022 is the year that we return to normalcy. Now, Jan 2022 in some ways stood up to that billing. Volatility and markets go hand in hand, but volatility had largely been non-existent for the past 2 years, and it came back in full force for the month of January 2022. Greeting viewers, you are watching Aman Sangha, independent financial advisor in Mississauga, Ontario. For my update for the month of January 2022, I will be breaking it up into three components. We'll start with the index returns, which really is the big story out of for the first month of 2022. But what I'll be doing is then spending more time on the subsequent points is in really like if you've been sitting on the sidelines or you have some cash, like is it really the bottom? Is it the time to go in? And lastly, I'll conclude by if this was a dark cloud on the markets, does it have any silver lining? So with that, without further ado, let's get started with the index returns. And you can see that whether it's bonds or it's equities, there is a lot of red. And the only good news I think out of this slide is that because of the last week or so, this is not as red as it was in the third week of January. The only black ink that's showing up here is the price of oil, which has jumped 20% already in this few weeks of this year. So let's get started with why was this drop down, and not that it was totally unanticipated or unexpected, but there has been a lot of talk out there of Fed raising rates, and they didn't raise rates for the month of January, but they laid a solid foundation or expectation that there is a rate hike coming in March of 2022. And the consensus is that there are likely going to be about 4 rate hikes this year, probably another 4 in 2023. And on the similar lines, coming back to Canada, the Bank of Canada had the same message, no hikes for the month of Jan, but expecting hikes to start in the month of March this year. So what that meant, higher rates means higher borrowing costs. Higher borrowing costs might translate into lower earnings. And that's what spooked the market. And what followed was the deepest drawdown we have on record for S&P 500. So, just a little bit dissecting this further is that, this is the sector-wise returns of S&P 500. So the typical growth stocks of healthcare and tech were badly impacted. Not only was that, but even the value stocks, they were pulled down with this anticipation. The only outlier being energy, which I've already mentioned, was riding on the back of the jump in the price of oil. Canada was no different. Tech and healthcare clearly led the drawdown, although the index didn't go down as much as S&P 500. But again, it was held up by the presence of energy in the index, and which means not as painful as S&P 500, but still you could see how the markets were spooked by the fear of rising interest rates. Now that's the first part. Now I think that's the second part is more important. Like, what do we do? Is there more likely to fall more, or is this, if I've been sitting on the sidelines, is the time to move in? Now nobody can be sure for certain if they're going to go down further. But another way to look at this is in terms of valuations. Now, if you look at the forward earnings, the forward PE earnings multiples, we are in S&P 500. We are trading at levels which were last seen before the pandemic. That was about January of 2020. The same thing is reflected in NASDAQ, which is almost at the same level in January of 2020. Now, this is US. If I come home to Canada, despite the run we had in 2021, the forward PE earnings multiple valuations are still lower than where they were in January of 2020, pre-pandemic. And similarly, for emerging markets, they are also lower than where they were in January 20. So just as a portfolio idea, like you see where the valuations are, where they're stretched, where they are less. So if you're looking for ideas as to how to reposition your portfolio to have these exposures, you know the number to call, 905-363-5035. With that, I just want to move on to the last part, which is what does this mean going forward? So if you look at it, we've already seen the market react to an expectation of about 3 to 4 rate hikes a year. But I think if you look at the other factor, that is inflation, which is at about 7%, there are indications that this number might have already peaked, or it's almost at the peak. And if you look at the ISM manufacturing prices page, they are starting to trend lower, which means that if the inflation has peaked, it could likely start drifting downwards from here onwards, so that it ends the year like in the ballpark of about 4.5%. So I think that should be good news, and we'll see how this plays out for the rest of the year. And if you're just looking at it from just purely from a statistical standpoint, if we look at all the previous drawdowns that we've had in January, I mean, you might say that they are followed by a rocky February, but overall, 2/3 of the time, the year has ended up on a positive note when we had a negative drawdown in January. So overall, the way I look at it is that the monetary conditions are still very stimulative. The rates are very low. The yield curve is still forward sloping. And it's a big if the economy or our lifestyles were to return back to the pre-COVID way of living, people are going out more, they're going to spend more. This should be good for the economy and should lead to higher earnings. In all, like, rising rates are a reflective of a healthier economy. Where they are currently is reflective of an anemic economy. So if the Fed is able to raise them the way they've been saying, they're really, what they're saying is that the economy is strong enough to be able to live with that raise, which are like normal rates for a healthier economy. So in that sense, I think this is good news, healthier economy, higher earnings, higher stock prices. So that's the way I look at it. Thank you so much for watching, and I'll be back in March. Take care.